Hello, I'm Sam Stovall, U.S. Equity Strategist for S&P Capital IQ. In this week's Sector Watch, I discussed how the speed with which the S&P 500 succumbed to the 5% decline threshold may offer a clue to the likely magnitude of the overall decline. The speed of decline, in our opinion, is reflective of investor behavior. For those 16 times that the S&P 500 took 40 days or more to fall 5%, the S&P 500 never slipped into a bear market, possibly because a drawn-out decline gives investors time to evaluate the concerns and dissipate the impact. While investors have already endured a white-knuckle ride on the S&P cyclone, this decline may not be over. We don't think the S&P 500 will slip into a new bear market due to the strength of the U.S. housing market and today's low level of inflation. What's more, investors are advised not to try to time the market since corrections required an average of only 4 months to get back to break even. That said, depending on the depth and duration of this decline, 2 stock market records are at risk. Depending on when the S&P 500 bottoms, the time required to get back to break even might result in a negative performance for the 500 in 2015. A down year for the 500 this year would be the first time since 1945 that the third year of a presidential cycle would be negative, and the first time since 1905 that a year ending in 5 closed lower. I'm Sam Stovall, and I'll talk with you again next week.